Florida's once booming housing market is losing steam.
I had one property that was on the market for 10 months and did not sell.
Now being labeled one of the worst places to sell a home.
We are counting down the 10 Florida cities most at risk of a home price crash in 2026. From rising supply and investor exodus to surging insurance costs and hidden oversupply, these markets are now flashing warning signs rarely seen since the last cycle. Which city faces the sharpest correction? And how did it top the list? Let us start our countdown with number 10. Tampa's housing market, once a magnet for out-of-state buyers and investors, now stands out for a rapid surge in homes for sale. By mid-2025, active inventory in the metro jumped nearly 40% year over year, far outpacing the state average. In neighborhoods like Riverview and Wesley Chapel, rows of for-sale signs and online listings tell the story. Nearly half of all available homes have lingered on the market for more than 60 days. Local real estate agents report open houses with sparse turnout, while price reductions have become routine, especially in newer subdivisions. Social media posts from flippers who once promised endless appreciation now feature apology videos and urgent liquidation offers. The city's diversified economy and steady job base have helped cushion prices so far, but the sheer volume of unsold homes is putting downward pressure on values. Unless demand returns or supply tightens, Tampa's oversupply could keep the market soft well into 2026, making it the first city on Florida's risk map for a potential home price correction. Jacksonville's housing market is showing clear signs of cooling, but the pressures here are more nuanced than a simple supply surge. Pending sales dropped by more than 24% year over year in late 2025, reflecting a sharp slowdown in buyer activity across the metro's sprawling suburbs. Inventory has crept up. Over 10,000 homes are now on the market, and months of supply sits at 5.2 months, just shy of a neutral market. While headlines about investor sell-offs swirl statewide, deed records in Jacksonville reveal no evidence of mass bulk sales by institutional landlords. Instead, the investor retreat is subtle. Fewer new purchases, more cautious listings, and a noticeable drop in the appetite for quick flips, especially in outer subdivisions where new construction has outpaced demand. Builders are still active in areas like Northside and St. John's, but incentives and longer days on market are becoming the norm. Despite the slowdown, Jacksonville's diverse job base and steady population growth have kept prices mostly flat, with the median hovering near $363,500. Risk. The risk here lies in lingering oversupply and a thinner buyer pool, not a dramatic investor exodus. Without a rebound in demand, the market could face further stagnation, but the city's economic backbone keeps a deeper correction at bay. For now, Palm Coast, tucked along Florida's Atlantic shoreline, has become a case study in how quickly small markets can turn. The number of homes for sale here has more than doubled since 2023, with active listings now topping 1,400, an inventory spike that outpaces most of the state. As supply has swelled, the median days on market has climbed past 80, nearly twice last year's pace. Local builders, facing a glut of unsold homes, have rolled out aggressive incentives, mortgage rate buy-downs, closing cost credits, and price cuts on move-in ready properties. Sales flyers and agent reports confirm that most new construction deals now come with some form of concession, a clear sign of softening demand. For retirees and snowbirds, the equation has changed. Insurance premiums are up sharply, and flood risk remains a constant worry. With a thinner buyer pool and investor interest fading, Palm Coast's housing market is exposed to sharper swings than larger cities. Unless demand returns or insurance costs ease, risk the risk of further price declines will remain elevated through 2026. Fort Myers stands as a stark example of how disaster recovery can fuel a housing boom, then quickly reverse into hardship. In the aftermath of Hurricane Ian, construction crews fanned out across the city and building permits soared as homeowners rushed to repair or rebuild. For a time, the influx of insurance money and federal aid propped up demand, with property values holding steady even as the rest of Florida began to cool. By late 2025, that momentum had faded. The median home price in Fort Myers is now down nearly 9% year over year, one of the sharpest drops in the state. Many residents face a new kind of uncertainty, not from storms, but from the financial fallout that followed. Lisa, a local homeowner, spent months navigating insurance claims and disaster loan paperwork after her house flooded. When her rebuild finished, she discovered her property was now worth less than her mortgage. Insurance premiums had tripled, and her appeals for relief went nowhere. Stories like Lisa's are becoming more common, as exhausted savings and mounting costs push owners toward default. With the rebuild surge behind them and buyer demand thinning, Fort Myers is left with rising inventory and a growing number of underwater mortgages. A clear warning of how quickly fortunes can turn in Florida's most vulnerable markets. Cape Coral's housing market is confronting one of the sharpest supply shocks in Florida. Active listings soared from about 2,100 in early 2024 to more than 6,500 by August 2025. That inventory jump pushed the city's months of supply from a tight 1.3 months to over 7 months, a dramatic swing that now far exceeds the state average. For buyers, the choices seem endless. Bis hindi wahas miyus. But for sellers and builders, the story is far less comfortable. By midsummer, the median home price had fallen 8.9% year over year, settling near $356,000. Properties are sitting unsold for an average of 90 days, and price reductions have become standard practice across nearly every subdivision. The root of the problem lies in a wave of speculative building that ran well ahead of actual demand. Major national builders, flush with pandemic-era profits, ramped up construction through late 2024. But as mortgage rates climbed and insurance costs spiked, buyers pulled back. By February 2025, builders began slashing prices on standing inventory and investor-owned properties flooded the MLS. The result is a city awash in completed but vacant homes. Sales staff are offering closing cost credits, rate buy-downs, and appliance packages to entice hesitant buyers. Cape Coral's extreme inventory imbalance has triggered a local market reset. Unless absorption rates improve or builders scale back further, the pressure on prices and seller expectations will likely persist well into 2026. The city's rapid transition from boomtown to buyer's market stands as a cautionary tale for Florida's mid-tier suburbs, where unchecked supply can quickly erode years of paper gains. Naples and Marco Island, long seen as safe havens for luxury buyers, are facing a rare period of vulnerability. Since the 2022 peak, high-end home prices have fallen 10 to 15%, a sharper drop than in most Florida markets. The slowdown is especially pronounced among cash buyers who once dominated local sales. They are now far less active. Agents report that properties once snapped up in days now linger for months, with median days on market stretching well beyond 80. Condominiums have been hit hardest. New state laws require condominium associations to build up reserve funds, leading to steep increases in monthly fees. Combined with higher insurance premiums, these costs have pushed many would-be buyers to reconsider, especially in older or high-rise buildings. Single-family homes are holding up slightly better, but even there, sellers are making more concessions and accepting offers below list price. The luxury segment's reliance on out-of-state and international wealth has left it exposed as global demand cools. Without a return of confident cash buyers or a reversal in ownership costs, Naples and Marco Island could see continued price pressure through 2026. While the overall market is smaller than in Florida's biggest cities, the depth of the correction at the top end makes this region a clear risk for further declines. Port St. Lucie's housing market is showing deeper signs of stress than most mid-sized Florida cities. Over the past year, home values have dropped 4.6%, and leading forecasts predict another 7.8% decline through 2026. The root of the problem is an explosion in supply. Nearly 3,000 homes are listed for sale, a 45% jump from the previous year. This surge has left many neighborhoods with rows of unsold properties and prompted local builders to pull back on new starts. The impact is visible in the numbers and on the ground. Homes now sit on the market for an average of 87 days, with sale prices falling 3 to 6% below list. Price reductions are routine, and open houses draw fewer visitors than at any point in the last 5 years. Builders, facing mounting inventory and slower sales, have responded with incentives, offering mortgage rate buydowns and closing cost credits. But these measures have done little to stem the tide of listings. Underlying all of this is a squeeze on affordability. Rising mortgage rates and insurance premiums have pushed many buyers to the sidelines, shrinking the pool of qualified purchasers. If demand fails to rebound, Port St. Lucie could see its projected decline become reality, making it one of Florida's most vulnerable markets heading into 2026. The city's rapid inventory growth and persistent price pressure set the stage for even deeper corrections if conditions do not improve. Orlando is facing a deeper housing challenge. By late 2025, inventory across the metro area has climbed between 30 and 35% year over year, with the sharpest spikes in fast-growing suburbs like Davenport and Kissimmee. Rows of new homes stand completed but unsold, and MLS data shows multiple offer situations have become rare. Instead, price reductions and longer days on market are the new normal, especially in neighborhoods where builders once raced to keep up with pandemic demand. Appraisals are where the stress shows up in the numbers. Appraisal disputes are surfacing at a pace not seen since the early 2010s. Homeowners who bought at peak prices in 2021 and 2022 are now discovering new appraisals for refinancing or resale are coming in tens of thousands of dollars below their original purchase amounts. In some cases, the gap is so wide, sellers are forced to bring cash to closing or walk away from deals. Local appraisers point to a mismatch between what buyers paid during the frenzy and what lenders are willing to back in the current market. This negative equity problem is especially acute in new subdivisions packed with similar homes, where comparable sales set the tone for entire streets. Developers are equally exposed. Many are carrying unsold inventory and have started to scale back on new projects, waiting for demand to return or for prices to stabilize. The financial strain is visible in builder incentives, mortgage rate buydowns, closing cost credits, and even free upgrades as they try to move standing inventory. If appraisals continue to reset downward and inventory remains elevated, Orlando could see a wave of forced sales and further price corrections into 2026. The risk here is not just too many homes. It is a market where the value of those homes is suddenly up for debate, putting both owners and builders in a bind that ripples through the region's economy. Northport, Sarasota, and Bradenton are now at the center of Florida's coastal housing risk. After a period of explosive growth during the pandemic, the tide has turned. Listing data from late 2025 shows a sharp reversal. The number of homes for sale across this corridor has surged, with active inventory now more than double what it was just 2 years earlier. Median days on market have climbed above 70, and price reductions are a fixture in nearly every neighborhood update. Analysts are sounding alarms about overvaluation. National valuation indices consistently rank this region among the most overpriced coastal markets in the country. Some estimates place local home values 20% above sustainable levels. The gap between what sellers want and what buyers can afford is widening, especially as wage growth lags behind the cost of ownership. Insurance turmoil has become a defining feature of the local market. Insurance strains are changing transactions. Since 2023, major insurers have withdrawn from the area or imposed steep premium hikes, leaving many buyers scrambling at the closing table. Local agents report a growing number of deals collapsing in the final days, not because of financing, but because last-minute insurance quotes arrive thousands of dollars above budget, or coverage is denied outright. One agent described a recent week with 3 failed closings in Sarasota alone, all triggered by insurance issues that would have been unthinkable just a few years ago. Visible signs of market distress are everywhere. Visible indicators include sparse open house traffic and frequent price cuts. Price reductions appear on nearly half of all active listings. Sellers who bought at the top are now facing offers well below their expectations, while buyers hesitate, wary of overpaying and of unpredictable carrying costs. Outlook. Unless insurance markets stabilize and demand returns, Northport, Sarasota, and Bradenton are exposed to further price corrections in 2026. The region's combination of overvaluation, a supply surge, and transactional friction puts it at the forefront of Florida's housing risk map, just behind Miami's even more complex market pressures. Miami and Fort Lauderdale stand at the epicenter of Florida's housing risk, where the convergence of high prices, regulatory upheaval, and evaporating demand is reshaping the market at every level. In early 2025, sales volume across the metro collapsed by 25% compared to the previous year, a staggering drop for a region that once thrived on international buyers and cash-fueled speculation. Median home prices remain among the highest in the state, hovering around $585,000, but the surface stability masks mounting stress beneath. Condominium towers, once a symbol of South Florida's endless boom, have become ground zero for the unfolding crisis. The new state reserve law, SB 4D, now requires condo associations to build up hefty cash reserves for structural repairs. Overnight HOA fees in many high-rise buildings have surged by 60% or more. Board meetings have turned contentious. Residents are protesting fee hikes, and petitions are circulating in downtown towers. Some owners, unable to absorb the new costs, have defaulted on payments, and foreclosure filings are beginning to stack up in public records. In one prominent Brickell building, monthly dues jumped by $800, pushing several units into distress sales. Insurance costs, already the highest in the state, have soared further, tripling for some properties since 2022. Buyers routinely discover at closing that premiums are thousands of dollars above projected budgets, derailing deals and leaving units unsold. The result is a glut of listings, especially in older waterfront buildings where both insurance and reserve requirements are steepest. Local agents report that open houses attract more lookers than serious buyers, and price reductions are now routine even at the luxury end of the market. The city's traditional safety net, foreign and cash buyers, has shown signs of fraying. International demand, once a reliable engine for Miami's real estate, has cooled as global economic uncertainty and a stronger dollar weigh on overseas investment. Cash offers, which accounted for nearly half of all Miami sales in 2022, have dropped sharply, leaving sellers with fewer exit options and longer marketing times. Investor appetite has also waned. Short-term rental restrictions and higher carrying costs have squeezed profit margins, prompting some landlords to list units en masse. The oversaturation is visible in MLS data. Condo inventory has climbed well above pre-pandemic levels, and months of supply now routinely exceed 6 months in many submarkets. Distressed sales and board disputes are no longer rare exceptions but recurring headlines in local news. To avoid deeper declines, Miami and Fort Lauderdale would need a dramatic return of demand, a reversal in insurance and HOA cost trends, or a regulatory reprieve, none of which appear imminent. The combination of high entry prices, regulatory shocks, and a shrinking pool of qualified buyers puts South Florida's flagship market at the top of Florida's risk map for 2026. For owners, investors, and potential buyers, the warning signs are clear. In Miami and Fort Lauderdale, the era of easy gains has ended, and the road ahead looks increasingly uncertain. Across all 10 cities, one pattern stands out. When rapid growth collides with rising costs and oversupply, even boomtowns become vulnerable. Florida's market stress is not a fluke. It is the result of stacked risks, from insurance shocks to inventory gluts. This is not just a real estate story. It is a warning that fundamentals, not hype, determine what happens next.